Raoul Pal has a specific number in his head, and he said it plainly in a recent long-form interview, $1 million per Bitcoin. Not as a marketing slogan, not as a throwaway line for headlines, as the output of actual math he walked through live based on how much of the world's money he expects to eventually sit inside this asset class. Pal is not a random voice in this space. He spent years at Goldman Sachs running hedge fund sales across Europe, co-managed a global macro fund at GLG Partners, retired from active money management in his 30s, and has spent the 2 decades since then publishing a macro research read by hedge funds, family offices, and sovereign wealth funds. He is not new to being right, and he is not new to being wrong. And in that same interview, he was refreshingly honest about both. Here's why this specific interview is worth a careful breakdown rather than a quick headline treatment. Bold price predictions are everywhere in this space, and most of them collapse the moment you actually check the arithmetic underneath them. This one is different in one important respect. Pal shows his work live on camera, which means it's actually possible to follow the logic step by step and check whether it holds up. This video is not going to tell you Bitcoin is going to $1 million. It is going to walk through exactly what Pal's argument actually is, check the specific numbers underneath it, correct at least one clear error in how those numbers were reported, and show you exactly what he says. Separates the holders who capture a move like this from the holders who don't. Let's be precise about what "if Raoul Pal is right" actually means, because it's doing a lot of work in that title. Pal's argument isn't simply Bitcoin goes up. It's a specific 3-part chain. Currencies are being debased faster than most people realize. A shrinking share of global wealth is chasing a fixed supply of scarce assets. And Bitcoin, being the most liquid and recognizable of those scarce assets, is positioned to capture an outsized share of that flow as it happens. Each link in that chain is checkable, at least partially, and that's exactly what this video does. Where Pal's numbers hold up against outside data, we'll say so directly. Where they don't, or where the interview itself appears to contain an error, we'll say that too, because an honest breakdown of a bold prediction is worth more than an uncritical repetition of one. It's worth explaining why this matters more for a prediction like this one than for an ordinary market commentary. A $1 million target is exciting enough on its own that it tends to get repeated and shared without anyone actually checking the arithmetic underneath it. That's precisely the moment a specific number is most likely to travel further than the evidence supporting it. And it's exactly the moment worth slowing down and actually doing the math, instead of just reacting to the headline. Before we get into the actual math, I want to mention something because everything in this video assumes you're still holding whatever Bitcoin you own by the time any of this could possibly play out. And that assumption is not automatic. Pal himself, in the same interview, was blunt about this exact problem. The people who get access to a generational asset and then lose it anyway, through leverage, through panic, or through chasing meme coins in the euphoric phase of a cycle, are not a small minority. He described it as watching people repeatedly given an incredible opportunity, only to sabotage it themselves, cycle after cycle, in ways that are entirely predictable if you know what to look for. That's precisely the gap the Bitcoin holder mindset was built to close. Across 13 chapters, it breaks down the psychological traps that cause disciplined investors to abandon their position at exactly the wrong moment, and includes practical checklists and worksheets to help you build a plan before emotions take over. Normally, the guide sells for $97, but if you stay with me until the very end of this video, I'll reveal a private coupon code worth $50 off, allowing you to get it for just $47. I won't put the code on the screen until the end. So, if you're serious about becoming the kind of holder who actually makes it through the entire cycle, make sure you stick around. The guide is available through the link in the description, and once you have the coupon from the end of this video, you can apply it there. Now, let's get into what Raoul Pal is actually arguing, and whether the numbers behind his thesis really hold up. Pal's starting point isn't Bitcoin at all. It's a claim about currency itself, that the value of money is being eroded faster than official inflation numbers suggest, through a mechanism he calls debasement, separate from and larger than headline inflation. His rough figure, stated directly in the interview, is that the average saver's purchasing power against scarce assets is shrinking by somewhere around 11% a year, combining an estimated 8% currency debasement with roughly 3% measured inflation. It's worth being clear about what kind of claim this is. It is Pal's own framework, not an official government statistic, and reasonable economists disagree on how to measure debasement separately from inflation at all. What is independently checkable is the backdrop he's pointing to. Global debt has grown enormously since the 2008 financial crisis, and according to the IMF's own global debt database, total global debt, public and private combined, sat at approximately 235% of world GDP in the most recent complete measurement, with global public debt alone around 93% of GDP. Pal's interview cites a considerably higher figure, describing the entire world as 400% of GDP in debt. That specific figure doesn't match any headline IMF or World Bank series available, and it's worth flagging directly rather than repeating uncritically. It may reflect a broader, non-standard measure of total system leverage that Pal tracks internally, but as stated, it runs meaningfully hotter than the most authoritative public data on the subject. It's worth walking through why this specific distinction matters rather than treating it as a minor rounding difference. A world genuinely leveraged at 93% public debt to GDP is a real, serious fiscal situation, but it is a fundamentally different conversation than a world leveraged at 400%, which would represent a scale of indebtedness with essentially no peacetime historical precedent at all. Overstating the underlying problem by more than 4 times doesn't make the case for scarce assets stronger. It makes the entire argument easier to dismiss the moment a skeptical viewer checks the actual IMF data and finds a meaningfully smaller number. The generational wealth argument fares similarly, partially checkable, partially a matter of framing. Pal argues that a 30-something today faces a meaningfully different financial reality than a 30-something in the early 1980s, less able to afford a home relative to income, more likely to live with others or delay marriage and children, carrying student debt that a prior generation largely didn't have. The direction of that argument lines up with a great deal of independently published research on housing affordability and wage stagnation relative to asset prices over the past 4 decades. The specific percentages Pal cited live in the interview, without a named source attached to them in the moment, should be treated as illustrative rather than independently verified statistics. And it's worth noting the interview itself contains at least 2 internal inconsistencies on this exact point. A 30-year-old living alone figure cited 2 different ways within the same conversation, once as roughly 80 to 62%, and later as roughly 85 to 64%, and a home ownership figure for the same cohort cited as dropping to 30% in one part of the conversation and 32% in another. Neither gap is large enough to overturn the general direction of the argument, but both are worth naming directly rather than smoothing over. A directionally accurate observation about housing affordability and generational wealth gaps does not, on its own, establish that Bitcoin specifically is the correct or sufficient solution to that problem. And a debasement figure that runs meaningfully higher than the most authoritative available data is worth treating with real skepticism, not because the broader concern about currency devaluation is baseless, but because overstating the scale of a real problem is its own kind of misinformation, even when it's aimed at a conclusion that might otherwise be reasonable. A genuinely accurate description of a serious problem should be able to withstand having its numbers checked. When it can't, the honest response is to correct the number, not to abandon the underlying concern entirely, and not to keep repeating the inflated version either. Before getting into the actual math, it's worth addressing directly why a specific person's credentials matter here at all, since price predictions are cheap and anyone can make one. A random anonymous account online predicting $1 million Bitcoin carries essentially no information value at all. There are thousands of such predictions circulating at any given moment, and the base rate of them proving accurate is close to what you'd expect from pure chance. A prediction from someone with a documented, dated public track record of macro calls is a meaningfully different kind of claim, worth engaging with on its own terms rather than dismissed alongside the noise. Pal's specific claim to a hearing on this topic rests on a documented track record. He wrote one of the first serious macro valuation analyses of Bitcoin back in 2013, when the asset traded near $200, arguing it was worth considerably more, even accounting for being wrong by a wide margin. He also says he saw the 2008 financial crisis coming in advance through the same kind of macro research he still publishes today, at a time when very few people in mainstream finance were sounding that alarm. Those are real, checkable claims about a documented public record, not simply a matter of him saying so after the fact. That history is worth taking seriously as one input. It is not the same thing as a guarantee. Plenty of people who correctly called one major cycle have gone on to be wrong about the next one, precisely because markets, technology, and regulation all keep changing the conditions that made a prior call correct in the first place. The honest way to weigh Pal's track record is as evidence that his framework deserves a careful hearing, not as evidence that his specific numeric target is destined to be correct. A track record built on a small number of prominent, well-remembered calls is subject to a specific kind of selection bias. The correct calls get repeated and cited for years, while less accurate predictions from the same person tend to fade from public memory much faster. Without a complete dated record of every specific prediction Pal has made, including the ones that didn't pan out, it's difficult to assess his actual hit rate with real precision. And that uncertainty is worth carrying into how much weight any single new prediction deserves. Here's where the interview gets specific enough to actually check, and it's worth walking through the math exactly as Pal presented it, correcting one clear error along the way. Pal's framework starts with the total size of the crypto asset class today, which he places at roughly $2 trillion, with a stated expectation that it could reach $100 trillion by around 2032 to 2034. From there, the Bitcoin-specific price target depends entirely on what share of that total Bitcoin holds, a figure market participants call dominance. At 40% dominance of a $100 trillion total crypto market, with roughly 19.7 million Bitcoin actually in circulation as of 2026, the math works out to a price of a little over $2 million per coin. At 50% dominance, the figure moves to around 2.6 million. Pal's own, if I'm 50% wrong scenario, a $50 trillion total market rather than $100 trillion, still produces a $1 million Bitcoin. Here's the correction worth making directly. In the interview as recorded, the current Bitcoin price is stated as $622,000. That figure does not match any verified 2026 pricing data. Bitcoin has traded in a range of roughly $62,500 to $65,900 throughout the second half of July 2026, according to daily reporting. It's very likely a transcription artifact, since the interview's own later math only makes sense against a starting price near $65,000. Reaching $1 million from there is explicitly described as roughly a 15-fold return, and 1 million divided by 65,000 is almost exactly 15. 1 million divided by 622,000 would be well under a 2-fold return, which contradicts the interview's own framing entirely. Using the corrected, verified current price, Pal's $1 million target represents an approximate 15-fold gain from where Bitcoin actually trades today. It's worth sitting with just how large a 15-fold move actually is, expressed in a way that's easier to feel than a raw multiplier. A retirement account holding the equivalent of 1 Bitcoin today, at a price near $65,000, would need to grow to $1 million to hit Pal's target, without a single additional dollar contributed. That is a genuinely staggering outcome if it happens, and it is exactly the kind of number that makes an otherwise careful thinker's math worth checking, rather than either dismissing outright or repeating uncritically. It's also worth naming the specific comparison Pal uses to make this scale feel plausible rather than absurd. He points out that his $100 trillion crypto scenario would represent roughly twice the total value the entire U.S. stock market, the S&P 500, took about 100 years to build, with his thesis being that crypto could reach that same twice as large figure in around 20 years. That's a genuinely useful way to frame the scale of the claim, even if it doesn't settle whether the claim itself is correct, and it's worth being precise about the twice, since understating it to simply the same amount would meaningfully soften how large a claim Pal is actually making. Every part of this calculation rests on an assumption about total crypto market size in 2032 to 2034. That is, by definition, a forecast, rather than a fact. And forecasts of this magnitude, an asset class 50-fold larger than today within less than a decade, have a poor track record across financial history generally. Bitcoin's dominance share has also fluctuated considerably over past cycles rather than holding steady, and nothing guarantees it remains anywhere near today's roughly 50 to 60% range as the broader crypto market evolves. A scenario where total crypto market size grows as Pal expects, but Bitcoin's own share of it shrinks meaningfully, as newer categories of digital assets capture a larger portion of that growth, would produce a very different price outcome than the one presented here. Even if the broader crypto grows enormously, thesis turns out to be correct. Let me pause here for a second, because this is exactly where a big, exciting number like $1 million becomes dangerous rather than useful. Pal himself made a point of no longer giving specific price predictions publicly, precisely because he's watched people build a false sense of certainty around a single number, extrapolate their own net worth from it, and then make emotional decisions when reality doesn't track the fantasy on schedule. He described it directly. Someone hears a number, mentally calculates what their own holdings would be worth if it comes true, and the entire relationship with the asset shifts from a long-term thesis to an emotional countdown, which is exactly the mindset that produces panic the moment price action doesn't cooperate with the fantasy on schedule. That specific failure mode, treating someone else's price target as a reason to abandon your own plan, is exactly the trap the Bitcoin holder mindset is built to prevent. Inside, the book walks through the specific psychological traps that cause holders to chase a number, panic when a cycle doesn't match a prediction's timeline, and abandon a sound long-term position because the excitement of a bold target wore off before the thesis actually had time to play out. The link's below if you want to check it out. Now let's get into the part of this interview that matters more than the price target itself. What Pal says actually separates the people who capture a move like this from the people who don't. This is the part of the interview most people skip past to get to the exciting number, and it's arguably the most important section in the entire conversation. Pal was direct about a pattern he's watched repeat across every cycle. A holder starts with a reasonable position in Bitcoin or Ethereum, watches someone else make outsized returns on a much riskier bet, moves further out the risk curve chasing that same outcome, adds leverage to accelerate it further, and then loses a meaningful share of the original gain, or the original position entirely, when the cycle turns. His own words for the entire thesis underlying his approach to this asset class were blunt. Your one job is not to lose it. He described this using a small, informal sample of his own closest friends, noting that the friend most heavily and actively involved in trading crypto, in his own account, ended up with the worst outcome of the group, while his own approach, buying a single asset, holding it directly rather than trading it, and largely not checking the price, outperformed more active friends, specifically because it avoided the behavioral traps that come with constant engagement. He was equally candid about his own mistakes, selling a position after a 10 to 12-fold gain in 2017 because of confusion around a network fork, only to watch the same asset continue climbing considerably further without him. There's a specific detail in how Pal described his own journey worth pulling out directly, because it undercuts the idea that expertise alone protects anyone from this trap. This is a man who has spent decades professionally analyzing markets, who wrote one of the very first macro valuation pieces on Bitcoin back when it traded near $200, and who still, by his own account, sold early in 2017 over a piece of confusing news, then bought back in during a 2020 sell-off, then sold again on the way up. His own math on that specific pattern, if he'd simply held his original position without any of that activity, he estimates he'd have made roughly 5 times more money than he actually did. If he'd followed his own stated rule of adding more during every major sell-off rather than trading in and out, he estimates the gap would have been closer to 25 times more. Getting the asset right and still meaningfully underperforming a simple, boring, do-nothing approach is exactly the pattern this section is trying to warn against. This is not a minor aside in the interview. It's arguably Pal's central practical point. Identifying the right trend and the right asset is necessary but not sufficient, and the skill of actually holding through the volatility that comes with a genuinely asymmetric bet is a separate, and in his telling, harder discipline than picking the trend in the first place. A single informal anecdote about 5 friends is not rigorous evidence about the general relationship between trading activity and investment outcomes, however intuitively plausible the underlying point may be. It's also worth noting that Pal's own account of selling too early in 2017 and missing further upside describes a specific decision that, in hindsight, looks costly. It does not establish that holding without ever adjusting a position is always the correct choice, regardless of circumstances. There are genuine, legitimate reasons to reduce a position at times, including changes in personal financial circumstances, a genuine deterioration in the underlying thesis, or basic diversification, and none of those legitimate reasons should be confused with the specific, panic-driven pattern this section is actually describing. Pal was not shy about the downside case either, and it's worth including directly, rather than only extracting the bullish parts of the interview. He was explicit that this asset class can fall 70 to 80% inside a single cycle, and that this volatility isn't a bug to be engineered away. It's a structural feature of an asset this new and this differently owned than traditional assets. He acknowledged specific risks directly, that governments have attempted and continue to attempt to restrict or shut down parts of this ecosystem, that any specific blockchain a holder chooses could lose relevance over a long enough time horizon if developer activity and usage migrate elsewhere, and that leverage specifically turns an already volatile asset into one capable of wiping out a position entirely, rather than merely producing a paper loss that a patient holder can wait out. He was also candid that his own view could simply be wrong, framing his own confidence explicitly in probabilistic terms rather than certainty, and naming the specific conditions that would change his mind, a reversal in the broader trend toward digital adoption, or the emergence of a demonstrably better solution to the specific technical problem Bitcoin's design was built to solve. It's worth noting how this specific kind of honesty functions inside a video like this one, because it's rare, and it's exactly what separates a genuinely useful macro thesis from pure promotion. A speaker willing to say, here are the 3 specific things that would prove me wrong, is giving you a falsifiable claim rather than an unfalsifiable one. And that distinction matters enormously when you're deciding how much weight to put on anyone's prediction, however credentialed. Compare that to a prediction with no stated conditions for being wrong at all, which isn't really a testable thesis, it's closer to a slogan. Acknowledging risk in an interview is not the same as pricing that risk correctly into a specific $1 million target. And a speaker can be honest about downside scenarios while still being wrong about the magnitude or timeline of the upside case. The specific 70 to 80% drawdown figure Pal cites is drawn from Bitcoin's own past cycles, a market 50-fold larger than today, with meaningfully different ownership and regulatory dynamics, is not guaranteed to behave identically to the market that produced those historical drawdowns. It's entirely possible a much larger, more institutionally owned market produces gentler drawdowns than history suggests, and equally possible it produces sharper ones, since neither outcome has actually been observed yet at this scale. Before we wrap up, I want you to actually sit with one question. If Pal is even directionally right, and Bitcoin does eventually make a real run at a number like this, what's your actual plan for the 70 or 80% drawdown that almost certainly shows up somewhere along the way? Not a vague sense that you'll just hold. The specific written version. What would make you sell? What would make you add more? And did you decide any of that before the volatility arrived? Or are you planning to figure it out live with your gut in the middle of a 40% red month? Think back to Pal's own story from earlier in this video. This is a man who wrote the first serious macro valuation of Bitcoin, who has spent decades professionally studying markets for a living, and who still, by his own account, left an estimated 80% of his own potential gains on the table simply by trading in and out of a position he already correctly identified. If that specific gap can happen to someone with his background, resources, and expertise, it is worth taking seriously as a risk to your own plan too, regardless of how confident you feel right now reading a headline about $1 million target. Because most holders don't miss a move like this because they picked the wrong asset. They miss it because they never built a plan for the exact discipline Pal himself says is the harder, rarer skill. Not finding the trend, but actually holding through what it costs to capture it. That's exactly the gap. The Bitcoin holder mindset was built to close. Inside, you'll get the actual mechanism behind why holders abandon a sound position under pressure. The reference point trap explained through Kahneman and Tversky's Nobel Prize-winning research. A dedicated chapter for anyone who has already sold in a past panic and needs to rebuild without carrying that mistake into the next cycle, and the complete pre-commitment system. Position sizing built around an honest sleep test, a way to decide your response to a drawdown before it happens instead of after, and a framework for building the kind of identity that holds steady through exactly the kind of volatility this video just walked through. On top of all 13 chapters, you also get the complete Holder's Toolkit, including the 10 biggest mistakes Bitcoin investors make, the 10 most important mindset shifts, the 10 most actionable decision frameworks, and a complete master checklist. The guide normally sells for $97, but if you watched all the way to the end, here's the coupon code I promised, Holder50. That's Holder50. When you click the link in the description or the pinned comment, simply enter the coupon code Holder50 at checkout. Once it's applied at checkout, your price drops from $97 to just $47, saving you $50 instantly. Remember, the discount is only activated when you enter Holder50 at checkout, so don't forget to apply it before completing your order. Raoul Pal, a former Goldman Sachs hedge fund sales executive and the founder of Real Vision and Global Macro Investor, has argued in a recent interview that Bitcoin could reach $1 million per coin if the total crypto asset class grows from roughly $2 trillion today to somewhere between $50 and $100 trillion by the early 2030s, with Bitcoin holding 40 to 50% of that total. Correcting a clear pricing error in the interview itself, using Bitcoin's actual verified July 2026 trading range, near $65,000, that target represents an approximate 15-fold gain from today. Pal's supporting argument about currency debasement and a generational wealth gap is directionally consistent with independently published research on housing affordability and wage stagnation, though his specific 11% debasement figure and 400% global debt figure both run considerably hotter than the most authoritative available data, which places total global debt closer to 235% of world GDP. Pal himself was direct that the harder skill in this entire thesis isn't identifying the trend, it's holding through the 70 to 80% drawdowns that come with it, without leverage, without chasing riskier bets during the euphoric phase, and without abandoning a sound position over a fork, a headline, or a friend's smaller, faster gain. None of that nuance is a reason to dismiss the thesis outright. And none of it is a reason to accept it uncritically either. It's simply what an honest breakdown of a bold, credentialed prediction actually looks like. The exciting number gets checked, the supporting figures get checked separately, and the parts of the argument that hold up get separated clearly from the parts that don't. Nothing in this video should be read as a confirmation that Bitcoin reaches $1 million, or that it does so on any specific timeline. Pal's own framework depends on a crypto market growing 50-fold in under a decade, a scenario with no direct historical precedent at this scale, and his supporting debasement and global debt figures do not match the most authoritative data available, which suggests his framing runs more dramatic than the underlying reality it's built on, even if the general direction of the concern is reasonable. A single credentialed voice being right about past cycles is not a guarantee of being right about this one. And Pal was explicit, in his own words, that this is a probabilistic view he holds, not a certainty. It's also worth naming a structural reason to treat any single macro voice, however credentialed, with some built-in skepticism. Predicting is Pal's business, and a career built on bold, memorable calls has its own incentive to keep making them, regardless of the base rate at which spectacular predictions across the entire industry actually pan out. That's not an accusation of bad faith. It's simply a reason to treat a well-credentialed person said it confidently as one input among several, rather than as the final word on what your own portfolio. If Raoul Pal is right, the math genuinely does point toward a Bitcoin price meaningfully higher than today's. And the argument underneath it, currency debasement, a fixed and scarce supply, growing demand for a globally accessible store of value, is at least internally coherent, even where individual figures need correcting or contextualizing. But the more useful takeaway from this entire interview isn't the number itself. It's Pal's own repeated point that the number means nothing to a holder who doesn't survive the volatility required to actually reach it. Consider the two ways this video's title could actually resolve. If Pal is wrong, and the crypto asset class never reaches anywhere near $100 trillion, the discipline covered in this video is still worth building, because every one of the drawdowns and the psychological traps described here happen regardless of where the ceiling ends up being. And if Pal is right, and Bitcoin genuinely does make a run at 7 figures, the only holders who actually benefit from that outcome are the ones who were still holding when it happened, which, based on everything covered in this video, is a much smaller group than the number of people who currently believe the thesis. Drop a comment below telling me, honestly, whether you think Pal's math holds up, and what your own plan is for the next 70 or 80% drawdown whenever it arrives. No judgment either way, and no need to have a strong opinion on the exact $100 trillion figure to still get value from thinking through your own answer to that question. If this video helped you separate the exciting part of this thesis from the actual discipline required to benefit from it, send it to the one holder you know who's already mentally spent $1 million Bitcoin without a plan for the correction that comes before it. Every bold price target in this asset class's history has produced the same split. One group hears the number, gets excited, and does nothing to prepare for the volatility required to actually reach it. The other group hears the same number, treats it as one plausible scenario among several, checks the arithmetic instead of just repeating the headline, and builds a plan sturdy enough to hold, regardless of which scenario actually plays out. Whether Bitcoin reaches Pal's number, some fraction of it, or none of it at all, the only question that has ever actually mattered is which group a given holder belonged to when it counted. See you in the next one.